Good evening, ladies and gentlemen. Welcome back to this live stream. We haven't done in a little while now. I haven't been as long gone as Roaring Kitty's been, but I've been on vacation. And the title of this video, financial freedom exhaustion, is a lot less to do with me, as it's going to have to do with the conversation we're going to have in the latter half of this stream, as there's been some intriguing data coming out, especially here in Canada, that about 76% of all mortgages are going to be renewing between now, 2024 and 2026. And there's this race to the interest rate cut cycle that the Bank of Canada, being the first G7 country to cut, is kind of, being like, hey, we're in this race right now. How fast can rates come down before renewals come up? And we're going to get into that and so much more on this live stream. As first and foremost, so many of you are asking me, where have I been? Where did I go? Well, it's not like I live for this shit. I love that as soon as I come back from vacation, like Roaring Kitty's back, all this drama's going on, and I'm like, this is what I live for, man. I love this shit. It's like you go on vacation, but then you kind of start missing it. You're itching it. You're watching it while you're gone, right? But it was well deserved. I haven't traveled anywhere in a couple of years. So where do we go? What do we do? Well, a lot of this actually has to do with what I want to talk about from the investing front as well, because firstly, we went and spent a few days in Rome, did the whole Vatican City, the whole Rome thing, which I'm sure if you've been there, if you haven't, worth going to see 100%. We went and saw all these buildings, really cool stuff. Vatican City is just absolutely wild. I mean, who thought they would build an entire city around a church just to house 70,000 artifacts? Cool stuff. But what really is the most impressive is what we did in between, because basically we spent a few days in Rome. We ended up in Istanbul. If you guys have ever seen the Blue Mosque, Istanbul, Turkey, crazy place. But the whole facet around this trip was primarily this ship you see in the back here. We went to this place, overviewed this volcano, but we were on this boat here by Royal Caribbean called the Odyssey of the Sea. And I had this fascination because I've never done a cruise before. It's the first cruise I've ever done in my life. And I got to say, it was one of the most mind-blowing experiences I've ever had, because you just don't understand the scale or the scope of these boats, right? Forget how I look. I mean, I kind of look like a tourist here. Like I'm like the definition of a tourist with my like school backpack here and a hat that I'd never wear otherwise. But yeah, I was looking at Royal Caribbean here, and this was my fascination going into this trip, because, I know so many people that spoke so highly of cruises, and after the crash of the pandemic, with this massive onslaught of this return of capital and earnings and all this stuff, like, I'm like, okay, so what is this cruise about? Like, what's the whole deal? Did a little bit of R&D and some research. And I've seen some people recently buying, obviously, pretty heavily back into these stocks. And there's no surprise, right? I mean, these things have come back with an utter vengeance. And I can see why. I mean, it's probably the most pristine way to travel, in my opinion. Like I said, I've never done a cruise. I know a lot of people that haven't, that just did one, and you start realizing there is no real way to travel than cruising. It's a brilliant experience, and these are cities on the ocean. They are huge. They have like indoor skydiving, casinos, clubs, theaters that seat 3,000 people on both sides of the boat. It's a little bit overwhelming all in all, but what really kind of caught my attention here is the margin expansion and how these companies have been making money. Because honestly, our experience was, I don't know how they were making money, because the money they must be outputting is absolutely insane. I mean, I think they had like over 1,000 employees. I think the boat holds like 3,000 or 4,000 people. And you can see that, like, coming out of the pandemic, the revenues have just shot up dramatically. But their margins, I figured they'd be making on like this onboard other revenue. I figured this is where most of the margin's coming from, because that's alcohol, that's casinoing. They do a lot of tricky things to get you to spend extra money. They have like a mall on the boat. Like, they're doing everything they can to get you kind of to spend a bit extra. And I figured this is where most of the margin expansion's coming from, when they made $1.18 billion from all this extravagant extra crap that you can spend money on, especially if you're an alcoholic. Bad place to drink. Very expensive to drink on these boats. They don't allow outside alcohol except for like 2 bottles of wine per person coming onto the boat. Only when you first get on it, not when you travel and stop at some of these places. But yeah, you take a look at the net income and everything's up. What I found really intriguing is, like, Royal Caribbean's got a lot of debt, like 29 billion versus 35 billion in assets. And they have been performing exceptionally well in comparable to Carnival Cruise, which, again, I don't know much about the difference in these cruise lines. I learned a lot about the different Royal Caribbean boats, the ones that were out there anyways. Carnival, I'm not sure what ones these are operating right now or how many they're operating, but they have had zero recovery, still down 75%. Yet I'd argue that they're almost in a better position. They just haven't been able to actualize a lot of income. And I'm not sure exactly why. Take a look at operating income on both of these. Like, you can see it's It's actually starting to, it's still lower for this company. Royal Caribbean sitting at a record net income, which again, I'm not surprised by. They've done a really efficient job with their boats. So I'm trying to figure out what the variables are and why Carnival's still spending more than they're making here. Not spending more than they're making, it's just their net income hasn't returned to where it was post-pandemic, yet their revenues are back to normal. You take a look here and they're generating way, way more money than Royal Caribbean is here as well. I mean, 5.4 billion versus 4.4 billion this time last year. Again, explosive revenue coming right out of the pandemic. People have come back with no hesitation on these things. And yeah, I've just been scrolling through this looking, and I'm curious to why their earnings suck so bad. I mean, you go through the expenditures and maybe they just haven't been able to refine and dine as much as Royal Caribbean has. I mean, they are depreciating about $613 million, which is a substantial cut from what could have been earnings. So, you know, I think there's just a little bit of misconception on what's going on with this balance sheet, because again, they have $49 billion in assets, you know, total long-term debt here at about 28. They're in a much more healthy position compared to Royal Caribbean. So, you know, I've seen some people playing these. Maybe they're, you know, at a time where, you know, maybe you could see it as a bit of a value pickup. But yeah, I'm just fascinated by this whole way of traveling. It was a really intriguing trip, all in all. So putting that aside, let's get going here. We'll talk about what's going on with the markets. Am I buying Royal Caribbean? No, but I'm definitely intrigued by it. It was definitely a good R&D trip from that aspect of it. You're so much better than Roaring Kitty. I do appreciate that, and I feel bad because I think a lot of people were super hyped up for that live stream. I mean, even at my work, we had a team meeting, and the team meeting was just watching Roaring Kitty. That was like the first half hour of our team meeting. I mean, I think there was an airline that shared a friggin' the live stream or some shit. Like the amount of people that were hyped by this, I think there was 600,000 like congruent live stream viewers. It's already got like millions of views after the fact. And it was like the most disappointing live stream I think I've ever seen. And more or less, I think because in the pandemic, there was this, you know, this massive onslaught of like, F the hedgies. It was this whole movement of like, forget the stock value. Like, let's just care about destroying hedge funds. And it just became this thing, right? Like it was just such an unusual thing. And everyone had helicopter money. There's money everywhere. And Robinhood just started gamifying the entire investing world. So it was just like this amalgamation of a lot of things. This time around, however, it's like that's not the purpose anymore. And you just start realizing like the dude just doesn't have any like real speaking skills. He's just like, there was no substance to that live stream at all. And I would have been shitting my pants for a lawsuit. It's like the guy had to be super careful, but there was no substance to it. It just seemed like degenerate gambling at best. And I mean, his thesis to GameStop was, hey, I pumped the stock. They just diluted and raised $3 billion. So they effed everybody over that's been fighting to pump the stock. And now they're going to have $3 billion, which means they ain't going broke anytime soon, but they have no business for the future. And they just have all this cash to rebuild up whatever their idea is. Like it's such a calamity, like a clusterfuck that I just like, like that was the whole, like he showed up half an hour late and the whole stream was just, like I don't know anybody that was pumped by it. You know, all that hype and he said nothing. Yeah, literally. I really like, again, I miss the excitement of just let's destroy the hedge funds, like the manipulation of big hedge funds. Like it was such a beautiful thing. And I feel like he should have just, you know, he made $100 million since he's been gone. Like he pumped up so much money in these markets. Why not just, you rode off into your sunset, man. Even if you just want to do live streams for fun, but to come back and throw it all in GameStop again, like your only bull thesis is that you're the one pumping it. And you are. I mean, he saved the entire company. I don't see Google in your portfolio anymore. Yeah, let's get into the portfolio side of things. We can do that for sure. Yeah, if you haven't been around or you missed some of my old videos, I sold Google out of the pure fear that I'm not sure what this new onslaught of ChatGPT 4, you know, the fact that people are using a lot of other search things, like I've come to the conclusion that I think Google has peaked for like users on Google. I honestly think the entire world is still catching up. There's a lot of people that still need internet, and I get that. But when you look at somebody like Meta prides themselves on the fact that their community of apps are still growing. Whereas, you know, Google's not really showing like active Gmail accounts. They're not showing active YouTube users. Like, I just feel like they're getting to a point right now where like Google's kind of hit this, there was a meeting that kind of got leaked where they, like the managers were saying that, hey, like we're in a new era here and we actually have to fight. The easy days are behind us. And it kind of hit me like a bag of bricks because I was arguing with a lot of people about it. And I was on the side that, you know, Google's not going anywhere. And I don't think it is. I think YouTube, if I could own Google without the search being the primary income source for Google, I'd own it any day of the week. I love YouTube. I love Gmail. I love all the other shit they do. I just hate that over half their income is coming from search. And I feel like they've been getting in this war with ad block. They've been doing everything they can to keep fighting and building search and ad volume. And I use Google Ads. Like, I am integrated into everything Google does. I do probably so much more than, like, through my work than most people do on an average basis. Like, I know how all Google Ads work. I've been up and down everything that they're doing that primarily sources all that insane amount of billions of dollars. And it scares the shit out of me that, you know, Apple is potentially in talks and is going to be partnering with Microsoft with ChatGPT. And it's an incredible thing. And honestly, I think I just feel like the ability for the amount of Google searches I've done have plummeted. I just don't feel like I'm doing as many Google searches as I used to. Sometimes I go on YouTube to search stuff, which is why Google is so fixated on growing YouTube income, you know, and I don't know. I'm just, like I said, what do you guys think? I mean, again, it comes to the point where right now Google search is losing every single day. Since I think about a year and a half, 2 years ago, they have been losing their share of search, and they're still over 90%, but it's trickling down. And I just, like I said, the big fear is that if Google loses 5, 10, 15% market share to ChatGPT or any of these other search things that start, you know, dominating, which again, if you just go on your phone now and you open up WhatsApp, you have a search feature now, thanks to Llama, right? Like Meta AI. I mean, the search things are popping up everywhere, and it's just one little piece that's pulling away from somebody that would have went to Google. And I'm just scared that if Apple doesn't partner with Google's AI software and they partner with Microsoft, you know, what's that going to say? I mean, the only reason Google's in the position they're in is because they have such good, you know, coincided partnership with Apple. So I'm just scared, man. Like I said, Meta is a better play to me than Google, which we own already. Like a lot of these, which is in my fiance's portfolio, but I just have this feeling that I don't want to take the risk with it because, again, they could go up for the next 2 years. I could be wrong. It could just keep going up, but it just takes 1/4 of them saying, hey, like, we've peaked. Google, like, ad share is going down, and watch the fucking stock implode. Like, it would easily cause a 20, 30, 50% correction in Google stock. I could see it happening overnight. It would just take 1/4, one statement. Hey, guys, we're fighting to keep market share, but we're losing it. That could come in a year, 5 years. I don't know, but I'm just scared of that inevitability. Well, like I said, with Meta, I see nothing but upside. Microsoft, nothing but upside. They have everything to gain, and Google has everything to lose in this AI race. And they're just, I don't know. Google will be fine, even with, like, they're not going anywhere. It's not like they're going bankrupt. It's just a substantial risk in the short term. And the short term to me is 3 to 5 years. Even with losing some market share slowly, they keep increasing prices and will partner with, yeah, like I said, their core business is fine. They have the best balance sheet of any S&P top 10 company, maybe not that comparable to, well, Nvidia is still getting there, but I think they're a great company. Like I said, it's just, there's going to be a lot of volatility risk. And, you know, we've seen Meta drop substantially. Like, I mean, these stocks could drop at any time. To me, I'd rather own it through the S&P and just kind of remove the risk. Whereas I'm kind of an idiot and I'm loading up on Tesla, which, let's be fair, is probably not the best pick considering where its revenue and income has been going. If Google dropped 20%, would you have jumped back in? Like I said, I took a 20% gain on it when I held it. It's not like I'm complaining about where I was at. If it dropped enough, maybe. Like I said, it's just that I don't know what the future holds. Like, when 50% of your income is the core driving of your business, and you're in now this new era where you have to compete again, and the easy days are behind you, what do? Like, do you trust that they can do it? Have you seen ChatGPT 4? I haven't seen Google release anything half as good as what they just released. And again, it just takes Apple partnering with them saying, hey, like, this is the new wave of how people are going to order, how they're going to search. I'm just going to ask ChatGPT to do all this for me. Well, guess what? There's no ad serving anymore, and you're screwed. And, you know, I don't know, like, again, it's something, if something like that happens, I mean, Google's business could crater very quickly. I just don't know. So I'd rather not take the risk. I just VDY, so I don't have to decide. Yeah, I had a good question. Let's get into some of this and talk about, like, where the future is going here, because VDY is probably a comparable risk with interest rates and all this stuff. Somebody did ask me, though. They mentioned here, I really like VDY, but every time I look at the total return compared to VFV, which is the Canadian, you know, currency converted S&P 500, it's VOO basically. I question myself whether I should give VDY a try. What is your opinion? VFV sounds way more interesting for the in the long run. And you've answered your own question here, because I can tell by this that you are looking substantially farther out in time. And if you are, and you don't care about income today, I would purely just buy VFV. Now, I'm kind of stuck in this situation here where, like, I want to start actualizing the income from my portfolio at some point in the next 5 to 10 years. I'm not looking to, like, retire at 60, though I might keep a job. Maybe I don't even tap into the portfolio. I don't know. But my primary goal is to get my portfolio in a place where my basic needs are going to be met between myself and my fiance by the time we're 35 to 40. That's the goal, right? And I know that's coming quick because I mean, I'm going to be 35 in 3 years. 40 comes in 8 years. So I'm looking at about, a 4 to 8 year time frame roughly that I want to start actualizing some of this portfolio. So in the meantime, like, that's not a very long time frame, and I recognize that, building up some of these positions like VDY, SCHD, because if something dramatic happened to the S&P 500 and big tech got absolutely devastated, black swan event hits, like, I might not see capital gains for a long time. That's the problem, right? Like, the S&P flatlined from the dot-com bubble pretty much till 2012, 2013, right? Like, if you bought the top of the dot-com bubble and you weren't cost averaging, it took a long time to actualize capital gains. So I'm trying to find this nice balance today where I still want growth, because I see Tesla in 3 to 5 years still probably having some substantial growth if things come into fruition. It's kind of a bigger risk bet for me. I see it having better upside than even Google does, probably. Just because of the way they're operating, though it's very speculative with the businesses. They're I'm speculating on a lot of what hasn't happened yet. So keep in mind, it's not financial advice. But like I said, I want to get about 30 to 40% of my portfolio for the time being in dividend-oriented stocks like VDY and SCHD to start continually building those positions out, because I'm going to actualize the income at some point. And then in the meantime, I'm always buying the S&P 500 because it's been the better growth driver, and Tesla just for some risk. And again, I have small caps, I have crypto, I have gold and silver and stupid shit that, like, it's so immaterial at the scale of the portfolio that it doesn't really matter. So I don't show it on here because I'm not like Roaring Kitty. I'm not trying to pump stocks. I will talk about them on my channel, but I've kind of come to this conclusion that I don't really need to be propelling, like, if it's like a couple $1,000 position, who really cares? If it's a private placement, which I own a few, who really cares? It's not like I own SpaceX, all right? Like, my private placements aren't that exciting right now, and they haven't done anything in a couple years. So why would I even consider it a reality of a position if it's that speculative, right? I'm in YTSL, and the monthly div is insane. Yeah, but it's not. I don't like getting the options. People get too heated about it. I'm on the side of, I don't like option ETFs. I think they don't yield nearly close to the returns people like to brag about. Oh, you go look at, people were throwing so many at me, and I said, look at the actual return of it, and is it really that high of a dividend yield? You're like, oh, I'm getting this wicked yield. Okay, well, come back in 3 years, break down the total return after the deal, because they're not really just paying you out that yield. You are losing some stock value, and then you get crazy fees on top of it. And then you start realizing, if you just bought a dividend stock or a bank stock or something that yielded like 4 to 6%, that was actually increasing the dividend, that over a 5-10 year period, you'd actually be in a higher income state than you would be owning the option ETF for most of the situations. After seeing how Google operates, in the movie, The Internship, I'm worried they spend too much time playing Quidditch instead of. So I'll state this, and then I want to get back to the rounded conversation here when it comes to interest rates, because there's risk with VDY. I think the Canadian economy has some risk right now that I'm very intrigued by. But firstly, when it comes to Google, I think I was really inspired when the CEO, he said, who was it? There was somebody that worked there that was on a podcast, and they said that when it comes to how Google looks at the future, they said they would scrap. This guy says they'd be working on projects that they spent 10, 20, $50 million on, and they would just come in and scrap them because they realized that the future TAM, or the total addressable market, wasn't just nothing. Google wants to look at total addressable markets that are trillions of dollars in value. So self-driving, artificial intelligence, quantum computing, things that you're not going to see actualize probably for about another decade, right? So that's what I liked about Google in the first place, was you had a company that, basically had these really fundamental businesses. Google Search, I thought that was undisruptible. YouTube, undisruptible. It's way better than Netflix. It's the most ultimate streaming service that exists. I like those businesses. And I felt like in the meantime, I was getting these incredible margins and all these cash flows. And then the cherry on top of the cake was when self-driving would kick off, or whatever would kick off, right? Now, arguably the same thing's happening with Tesla, right? Like, people thought the auto business could really propel Tesla, but now we're in a tougher market environment. So Tesla stock's down 50%, blah, 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 blah. Where that future goes, nobody really knows. There's risk with that. But that's like, okay, I get the auto business and all these other businesses. But in the meantime, while the auto business is scaling, I get the cherry on top of the cake when self-driving comes into play, when robotics come into play, when, power walls and all these other battery plays like start to expand. Those are like the best business models I think that exist. They're not, unfallible, as we've seen with Teslas. We're probably going to see with Google Search. I mean, that's the reality of these businesses. But I think, I think I love businesses where they make all this money and their only future prospect is another $1 trillion market cap opportunity. They don't want to make a software like Palantir. Like everyone's like, well, why isn't like, I'm sure Palantir's gotten some offers. It might be even Microsoft might be more intrigued to buy something like a Palantir because Microsoft seems more like a company that likes to, like I said, Microsoft to me is like an engine. It's got all these pistons in it. It's got a lot of fundamental businesses that make a lot of money. And every time one of those pistons stop firing at a high rate, which is usually like double-digit growth, and I've said this, anytime you look at one part of Microsoft's business that is dropping into the single digits, watch them. They'll go acquire a company. That's what Microsoft does. Like they're running a car and they need to keep all engines firing at like full rate. So they went and acquired Blizzard when gaming started to deteriorate for them. I mean, they'll do what they can to keep the double-digit growth up on their cylinders. Whereas I think Google and these other companies, they don't operate in that fashion because they just don't have that many cylinders. So they're like really just kind of core focused on a few things, which arguably, again, makes Microsoft a more diverse, better business. But I still like these companies that have very core focus and like massive market opportunities. Because like I said, you think Tesla's expensive today. I mean, it's like watching what's happening to NVIDIA. I mean, that's literally what could happen to Google with quantum computing or anything. That's what could happen to Microsoft with ChatGPT. That's what could happen to Tesla with self-driving. I mean, eventually these businesses are going to be worth so damn much that they're going to actualize in a way that's going to explode the stock. At least that's my bet. But anyways, let's get back into this because I really want to talk about the interest rate because that's the next big thing to all these companies. I mean, a lot of people think tech is super expensive right now, and I still think it's debatable depending on what interest rates do to the economy because credit card spends down a lot. We talked about a lot of this stuff. Actually, there's one question that I want to get into because it says, in my opinion, the rate cut came too early and was irresponsible, to each their own. So I've been stating that we need interest rate cuts now. I think the economy has proven that inflation is more or less dead. The primary cause of inflation today is self-inflicted mortgage prices and gas, which is stupid. Like, especially in Canada, when we have carbon tax on top of gas. In the US, I mean, you can control gas prices. It's dumb at how stupid. It's 2024. And we're stuck by OPEC controlling the gas prices. It's a fucking joke. But still, I mean, outside of that, everything's down. I mean, the fuck's going on here with like interest rates, and people keep arguing this, but I think what's going to get real scary and like the reality of why banks have been building up these massive war chests of capital. Because again, why are they still building loan loss provisions? The loans haven't been defaulting at an escalating rate. Like they're very reasonable. They're going up slightly, but they're reasonable. But the reason they want this big war chest is because they're very worried about when all these renewals come in the next year and a half, 2 years. And when those renewals come in, and we're going to watch a quick video here because it's just going to kind of give an example, and I highly recommend watching it if you live in Canada, because again, the same thing could very likely be happening in the States to some degree. It's the scariest thing that we're going to be dealing with in the next year. But honestly, I feel like we get through this hurdle and they cut interest rates enough. The rate of return in a lot of stocks like real estate investment trusts, which aren't as hindered by this, by the way, REITs, a lot of REITs are more cushioned because they don't have the same kind of leverage. But I think there's a few things that I've learned about mortgages. Firstly, people that took on, one of the biggest risks, a lot of people that took on like the interest, floating interest rate mortgages that, back during 2 or 3 years ago were the lowest rates you could get. They haven't exactly exploded for payments because I didn't realize what the bank does. And I'm going to try and simplify this because I'm going to sound like an idiot. I'm not a mortgage broker. But the way this works is you can take a mortgage from the bank at basically, interest only, like the interest rate mortgages, but you could lock it in on a monthly payment. So you can get a floating rate mortgage. So basically the interest rate changes with whatever the federal rate is. So like if the rate's all the way at the bottom, you get the lowest rate. And if it goes all the way up, guess what? You have to pay it as it goes up. However, they've locked in the monthly payment. So you lock in a term of like 3 years where the payment remains exactly the same, but the interest rate changes. So what's happened is the amortization rate, the amount of period you have to pay back that loan has exploded. So a lot of people were like, oh, my mortgage will be paid off in 25 years. And that monthly payment is locked in for 3 years, but then interest rates exploded. So their monthly payment didn't go up, but the amortization went up by like 20 years. 25 years. So now their mortgage is like a 40, 50-year mortgage. And they won't actualize that until the 3-year renewal comes up on the monthly payment. So they're not even putting anything toward the actual, property. They're not putting principal. They're just paying purely into the interest. And those people are going to get fucked. Like those are part of the people that are going to get royally fucked because they're stuck at the highest damn rates. And I mean, it's bad. Like there's a lot of bad. Anyways, just watch this. I think it's a bit insightful, this little bit here.
The time it will take to pay off his mortgage nearly doubled from 25 to 47 years.
I wasn't happy when I saw that. At first, I thought it was actually a mistake.
BMO, TD, and CIBC all allow for these negative amortization periods, which is just a jargony way of saying that they're stretching the length of your loan. They say those kinds of terms actually help their clients weather interest rate hikes by, keeping their monthly payments stable, keeping them predictable. But you can't keep extending your loan forever. At the end of your 5-year term, things snap back to reality, meaning your payments shoot up.
For those people, when they renew, it could be shocking, like legitimately shocking.
According to a recent report by RBC economists, some of these variable rate mortgage holders could see payments jump as much as 84% by 2026 if interest rates do not decline. And remember, for some people, part of that will be because they've paid down so little principal. Worst case scenario, their outstanding loans could be nearly as big as they were at the start because they've just been paying interest the whole time.
They might have been spending the last 5 years thinking that they were building up some equity in their home, only to find that all of that's now been eliminated.
Now, luckily, most economists do expect rates to keep dropping. But according to that same RBC report, it still might not be enough to, quote, save this cohort. To get them down to a more manageable monthly increase, like 20%, they argue the Bank of Canada would have to lower its prime rate way down to around 0.25% by July 2026. Something they admit is an unreasonable expectation at the moment.
The cuts are going to come at a slow and measured pace, not the way that they went up.
So you kind of get the idea here, right? But this comes into question. What does it mean for the banks? And honestly, I feel like here's the weird, interesting dilemma that Canada has, right? Like Canada has this explosive immigration. Like our housing is completely messed up. There's no fixing the housing problem, because the problem right now is new construction builds. All this new construction they want to implement, it's too expensive for construction guys. I mean, they're getting screwed because they have to borrow money to do the pre-construction, and people just aren't buying condos like they once were, and it's put a big halt. But we have this mass influx of people still. We saw this massive disconnect between supply and demand, which again is no different than New York, San Francisco, these markets. That's where we're headed right now. However, we're stuck in this kind of perplexing time period where a lot of people's mortgages are going to come up, which means there's a chance we could see an onslaught or a continued onslaught of supply, which means we could see a flooding supply of people that need to sell their homes. And we're going to be playing this balancing act of interest rates are starting to come down. And what is the peak amount that interest rates have to drop for all of a sudden real estate to become affordable again? Is that down to 2%? Is it 1%? Is it 3%? I don't really know, but that's the game we're going to be playing in the next year or two for the banks. The banks have a ton of loan loss provisions aside. They're prepped. They're probably shitting their pants to some extent. But then you have the market, like people like us that are like, hey, like we want to buy a house. We've got all this down payment. We've been living with our parents. All these people are coming in from all over the world with a lot of money. They all want to get in at some point. So what's the peak amount that interest rates have to drop before we start seeing an influx of people willing to buy for new construction to start kind of regaining traction? I don't feel like housing will ever really collapse and the banks will ever be in a place of like absolute shit, because there's typically always somebody there to buy the property. Right now, the demand is like the volume of sales has dropped a lot. There's not a whole lot of supply, though it is upping a little bit, but nothing crazy. We're just kind of stuck in this flatlining, like the heart's just not beating for real estate right now. And the question is did we just come out on the other side of this okay, and the market stabilizes, prices start to stabilize, maybe, or maybe we see a complete collapse of a lot of people putting their houses on the market. But you have to remember, over one third of all homes right now are owned. So that's another cushioning reality to the Canadian housing market. A lot of Canadians are rich. It's part of their retirement. Like I said, so you got 1/3 of people that just don't have a mortgage on top of that stabilizes a lot of the housing. So who knows? Do you personally own a home? Yes, I do. We just, again, if you're new to the channel, we bought a condo in Toronto back last September at a 5.8% interest rate, which we laugh because it went up even from what we were getting. Because now I think now you can get back to 6% with the recent cut. But still, we bought a property because we wanted to rent, and renting was like $3,300, $3,500 a month. And we said, fuck that. I'm not putting $40,000 a year into a rental. And we had, again, savings, me and my fiance. So we just put a massive deposit, and now we're saving over $1,000 a month from renting. And well, like I said, the goal for us is to pay the mortgage off probably within the next 3 to 5 years as part of that fast track financial freedom retirement thing, which for us should be doable if our jobs sustain and our income remains kind of similar because we both have full-time jobs. So we took that bullet and realized that, hey, like if you want to buy a house, now is probably the best time because you're not competing with anybody. Prices have come down. I mean, if you go out and you can afford to buy a house right now and you've thought about it, this might be your best opportunity because when those interest rates drop enough, we're going to be back to a normal housing market here, and it's going to probably start going back up because, again, the supply and demand isn't going to get fixed overnight, and it's the fact of reality. We're just going to become New York eventually. I mean, we're almost there. It's getting there. For Toronto, I don't know where you live, but Toronto's crazy. Instagram teases us Texas realtors showing mansions for like $500K. Yeah, if you leave, I mean, you never watch the videos here in Toronto. People are selling their fucking $3 million bungalows for friggin' castles in France. I'm like, we were in Italy and everyone's telling us how expensive Italy is. And yeah, the currency conversion with like the euro sucks for Canadians, but the cost of a house there is still a hell of a lot cheaper than here. I'm like, if you can make it in Toronto or New York or one of the, you know that saying, like if you can make it here, you can make it anywhere. If you figure out financial freedom in a city like this or wherever you live, like in these crazy expensive, like if you're like me, Kevin, in California, like you're basically a billionaire in any other part of the world. Like if you go to any part of the world, like you're loaded, like you're beyond loaded. It's crazy how expensive these cities really are. What made you choose an apartment instead of a home? Because homes are way too fucking expensive. Apartments have high maintenance fees too. No, yeah, yes and no. Honestly, I prefer a condo over a house because we don't like maintenance. I don't have to shovel my driveway. We have heated underground parking, which is awesome in winter. First time in my entire life, I haven't had to shovel snow or take ice off my car. I mean, we're a gated community, so we have security. The amenities here are amazing. Indoor, outdoor pool, like communal saunas, like, you know, we have indoor badminton and like actual like pool tables and squash courts and indoor, like, you know, everything. It's crazy. Pong. The community here is nice. I love it. So, I mean, I'd take a condo over a house any day if you're living in a city just for the amenities and the lack of having to deal with home ownership is crazy. We have people that come in and check our heaters twice a year and our fans. Like we don't fix anything. It's such a nice way to live, especially when we're traveling, right? Like we just went on a vacation. I don't have to worry about anything. You lock the door. I'm out. No, I got a camera, like cameras around, but you know, I don't got to worry about shit. Yeah, sup player. I'm late. Hey, congrats. You made it. Yeah. I don't know. It's your lifestyle. I hate housing, man. I at this point, I'll never own a house. Cause I just, you know, everyone's like, oh, you own a condo now. Now you can build up equity and then sell it or, you know, rent it out and then go buy a house and cash out. I'm like, I'm not buying a house. You know, I think it's just too expensive. If I have to put $1 million into a house, I'm leaving. That's it. I'm out. I'm gone. Peace, bro. Like this friggin' condo costs us as much as a mansion does in Alberta, you know, so no thanks. No, thank you at all. So basically let's get into another couple comments, questions here before I continue to ramble. We're kind of talking about the banks, but yeah, I'm good with the banks. I'm still buying things like TD or not. We're not buying TD. I'm kind of cost averaging it through VDY. My fiance does own it individually though. I had a few homes in North Bay. Rental market is super good there. You check. Yeah, you can check it out. Yeah. Honestly, if you can get out of Toronto, go live in Alberta, Newfoundland, North Bay. These are beautiful places that are much more feasible. I live in Toronto though. Honestly, the rule here's the thing. If you live in the city, you have to come. Let me just finish with this because this is true beyond Toronto. You have to stomach this reality that no more than 30% of your take-home income should be going to your direct housing costs. And this is where people's minds get blown because the fact is, and the scary thing with a lot of these mortgages is 70% of people that live in these metropolitan areas like Vancouver and Toronto, 70% of their take-home pay is going toward housing. Fuck that. That is a surefire way to never retire early. It is a surefire way to not have vacation and live a nice life. Like I said, we started investing early. You know, we put a huge amount of money into this property. Like I said, we have enough money to pay it off tomorrow if we wanted to. Like, I'm not trying to brag. It's just that financially, like, we were able to make it work because we've been diligent since we were in our early 20s, like two of us, not one of me. Like, I couldn't own this place on my own. Thank God I met a woman that like was smart with her money. Because I mean, that's what put us in the position to get this property and make it so we could live close to our family. But we were ready to move to Alberta. Like that was on our plate for a long time. We talked about it for months about leaving Toronto. And the family is what kept us stuck here. And we said, hey, like, we could semi-retire now in Alberta. Like we have a couple like cousins and stuff there. Go there now. Guess what? I'm like, I would have made a video being like, hey guys, financially free. Like our basic needs are met. Because the condo we would have bought would have been like 200,000 or 300,000. We could have bought a friggin' house for 350 or 400,000. So instead, we bought a $750,000 property in Toronto, which has slowed that rate of retirement down. But I'm glad we did it because we're close to family. However, you have to be realistic, and the realistic reality is most people should not live in the city because they can't afford it. If your rent and your house are costing you more than 30% of your take home, you either need to go live with people. You need to leave where you're like, just go get a job somewhere else. It's more affordable. It's just it's a sad fact of reality, man. I live in north of Barrie and it's still renting at 33. There's nothing wrong with renting. I would have rented. I would have been a renter. Like the problem was we were ready to move out in 2019. Toward the end of 2019, I'm ready to move out. Like me and my fiance were together for a while. Like it's already been like we've been together for like several years. It's already been a while. We're like, let's move out. Like it's time, right? And then the pandemic hit and I lost my job. My job cratered and imploded. And I didn't know what to do with myself. So I was like, I'm going to keep doing this YouTube stuff and I'm going to take the government helicopter money because I was actually entitled to it. And I'm like, and I sat around for a year. And before I knew it, this career blossomed. I never went back to the entertainment industry. And it was great. And now we're like, okay, we're ready to move out again. It was like 2023. We're like, it's been a few years, like 2.5 years since the pandemic. We got over it. We're ready to move out. Life is stabilized. The markets returned greatly. We made a lot of money. It was great. It was awesome. 2021 was an incredible year. Meme stocks made us rich. MindMed, Tesla. We went to the moon with so many things. It was beautiful. So anyways, we looked at renting and guess what? Rental prices went through the fucking roof. You can't get a basement apartment anywhere in the GTA anymore for under $2,500 a month. I mean, hell, the place that we bought, even though it's a bit cheaper, still rents for $3,400 a month. I'm like, you know how crazy that is? I'm like, I just couldn't stomach it. And that was the sad reality. But if you can rent for an affordable price somewhere, I would just rent. I didn't want to sink as much money to this place. Again, it's so personable to your circumstance. So just like I said, you have to be smart. Don't listen to me. Don't listen to other people. You have to sit down and do the math for yourself. Look at your personal circumstance. Do you want to live here for the next 20 years? Is it going to be more than 30 to 40% of your take home? Like you have to really consider all these factors. Are you married? Do you have other income? What's your total income? Is that income sustainable? Is it reliable? Can you still meet your retirement goals? Because again, like, do you want to fast track retirement? Do you want to retire when you're 60? There's so many factors that again, personal finance, right? But anyways, here's a fun question that I thought was interesting with the chip play in data centers that will be built. What's your play on how they're going to basically get powered? Nuclear, renewable energy. Would BAM be a longer play? What's your thoughts? So when it comes to this, again, I'm more in the camp of BAM is a great company. Obviously, Brookfield, these companies are incredible. The problem is like they're very cyclical right now and they've cratered because the cost of renewables have plummeted. Like you can get solar for nothing. It's actually becoming a very competitive business. It's not as reliable as it once was because a lot of these companies realize that they don't need a lot of these third party power producers. A lot of them can just retrofit their buildings and they're using like all these other companies and whoever's cheap to come in and install them and get them done, whatever. So like you got to be a little bit careful because there's going to be power being drawn from everywhere, but nuclear is going to be the future. There's no doubt about that. Nuclear is the most sustainable way of producing power. And you can look at things like Southern Company. I don't know if you've ever looked at some of the utility providers. I don't own them anymore. I used to own Southern on an individual basis. These kind of companies that run nuclear power plants, I think they're going to see some good growth probably into the future because nuclear is just, I think it always blows people's minds when you tell them that. I have this conversation actually probably more frequently than I'd like to admit, but nuclear power is less carbon emitting than wind and solar combined and has had a less death toll than wind and solar have. Think about that. Nuclear has had a lower death toll than wind and solar. And people keep thinking Chernobyl and Fukushima and all these things. It's like there's been a few events from human stupidity that can never really happen again because new nuclear power plants have like electromagnetic shutoff valves and things that just prevent meltdowns the way they used to happen. So they're very safe. But the fact of the matter is wind, solar, they're massive footprints. They cause a lot more foot labor, which leads to more accidents, and electricity is very dangerous. So you got to be a bit careful. But yeah, I mean, obviously it's the future, right? I mean, we've seen uranium explode, right? Like what's uranium prices at? I know they came down a little bit, but they, let's see, let's just take a look at the uranium price chart. Uranium, I mean, if you don't think nuclear is the future, just go look at the uranium price chart. I mean, it's mind blowing. Look at this. Look at this shit. Zoom out on 25-year. Look at that. We're at uranium levels we haven't seen since literally 2007. It's like there's a reason for that, folks. People are stockpiling the shit out of uranium right now. Nuclear is the future. It's pretty obvious. Yeah, I agree. I think people like these tree huggers are caught up in like these movies from the past, and they think it's a horrible thing. And it's the future. Uranium is the most fascinating way of generating power, I think, that people just underappreciate. Hell, we have aircraft carriers and submarines running on nuclear reactors. Yeah, exactly. And those are probably more unsafe. Let's be real. I don't want aircrafts and things in the ocean running on nuclear. That's super, super scary. I just want it to be in a nice localized area where it's very controlled and it powers like, hundreds of thousands of homes with a very tiny footprint. It's great. Let's get into another question quick here. We'll move on. Thanks for your thesis. So this is a corporate question that I think is fun here because a lot of people, the fastest way to fast track wealth is start a business. And I've talked about this a lot, but somebody was saying my new corporation has no expenses and I have passive personal income. I have no reason to leave my money in a corporate account, but let me say that again. I have no reason to leave the money in my corporation, but am concerned the tax man will take 15% plus 40% personal. This seems ridiculous to me. So the way I've kind of structured my corporation, and I like it because it severs liability from me. If my wife leaves me, she can't really take the corporate money. If I die, it's easier for my wife to get the corporate money. She can just adopt the shares. I mean, there's a lot of, liability stake that really separates it from yourself in a corporation. But the concerning factor in Canada is the government taxes passive income at like 50%. So if you own a corporation, you buy a stock, and let's say it's a capital gain like Tesla, and it goes up for 10 years, and you're up 100%. You doubled your money, right? And you sell it. If you sell it and you leave that money in the corporation, the government's going to take half of it. It's not an inclusion rate. It's not like, oh, you're going to get taxed on 50% like in your personal income tax bracket. No. They're going to take 50%. That's their cut because you're already getting a lot of tax breaks in a corporation because corporations only pay 13% on the first $500,000 of income. There's a lot of corporate tax breaks in Canada. So what you need to do is understand that you have to pay that money out. So you have to do this kind of in a coordinated fashion almost. It's like an RRSP. Like you already get all these tax breaks. You can invest super easily in a corporation. You can make all these capital gains. It's just when you actualize the gain, you need to talk to your accountant because typically what you can do is pay that money out. And if you pay it out to employees or shareholders, I don't know what the best way to pay it out is, but you pay it out as a dividend, a salary, whatever. You pay it out. And basically what happens is the government waives the corporate income tax. And then the tax liability gets put onto your personal income tax. So then you just wait till you're in a lower income tax bracket. So my example, for instance, I want to retire early. I'm going to use that corporate income. Even if I'm not running the corporation anymore, it's going to be a holding company that produces passive income, and it's just going to pay that passive income out to the shareholders, me. And I'm going to use it like an RRSP, and I'll only pay out what is required within the lowest tax bracket of my expenditures. On the other hand, and as well, instead of just paying some of that money out, I'm not sure how corporate expenses work with passive income, but because my company still makes money, I write off 1/6 of my housing costs that I don't pay any tax on. So corporations, very easily, they spend money and then they pay taxes after. If you work for a company and you have taxable income, you pay taxes first and then get the money, right? Like you have to pay taxes before you get to spend it. In a corporation, you get to spend it first and then pay tax on what's left. So like if you learn all these different facets of like the Canadian, like it took me years to figure this shit out. It doesn't happen overnight, but if you can learn how to operate all these functions of the tax system, and you don't even need, the fun reality is you don't even need to make money in a corporation to literally take advantage of corporate write-offs. So let's say you work for a company and you're just making regular income. You can just say, hey, I'm running a side hustle. You don't have to incorporate yet. Like you don't have to rush into a corporation, but you can say, I started my own business. I'm working from home. And you just tell the accountant, like, I need to write off some of my home expenses. So then you can even get some more tax money back because you can say that it was a write-off for your small business that isn't profitable yet. I mean, like, like I said, I should do a course on it at some point, but just a suggestion. If anyone's interested, financial independence, retire early, I would suggest the channel Two Sides of FI. Yeah, there's a lot of good channels. I follow a lot of smaller channels too. Like Rebecca is one of my favorite OGs that I've been following for a long time. If you want, like, I like personal people. I gotta look up her subscriber, Financial Fire Movement. Let me just see here. I'm spelling her name wrong already. Let's see if she's here. I got subscribed to, yeah, right here, Rebecca. She's awesome. I really recommend. Like, I like these small YouTubers that are like, you know, she's a nurse, or I don't think she's a nurse, but she works in hospitals. I love these kind of people. These just small individual like YouTubers most people don't know, that are just like crushing the game, working like 2 or 3 jobs, that are like have this retirement date. And we're all kind of doing the same thing from our own perspectives. It's a wonderful thing seeing small people. Do you have Blossom? No, but I work with Blossom. The problem with Blossom is I have to make, I think I have the Blossom account. I just haven't made my portfolio on it because it's all done through Wealthsimple, but I don't use Wealthsimple. So my portfolio doesn't get added. Plus, I work with them. I know Brandon pretty well. If you guys know Brandon Beavis, I talked to him. I haven't talked to him recently, but I've worked with him with Blossom for some other facets of our businesses. But yeah, anyways, if you leave money in a corp, can you make use of the tax deferral benefits? Not too sure. I have to double check. What do you think about the interest rate drop? We talked about that. Go back if you want to talk about that. Just had better experience with VFV than other stocks. Yeah, for sure. VFV crushes it. What are your thoughts on me being 22 years old with around 30K solely in VFV? My goal is to get around 100K in VFV before investing somewhere else. That's fine. Like I said, if you're not a degenerate gambler like I used to be, like I said, it depends on where you're at in your life. For me, you know, back in the day, I used to own individual stocks because like I didn't make a lot of money at my job. So when I wasn't making a lot of money at my job, I realized my only real facet to growth and excelling my life was trying to handpick companies. And I had a lot of time during the week. I was an entertainer. I only worked on weekends. So 5 days a week, I was learning about stocks. But now I make a lot of money at my business, and my business takes the core focus of my time. And I would rather own passive weighted indexes because it's just less stressful for me. Because like I said, when you're working as much as I'm working, it's really hard to just manage and look at stocks all day, every day, and just be comfortable with like the volatility of it all, especially when your portfolio gets bigger. So, I mean, if you have a good job, you're working your 9 to 5, you're grinding it out. Yeah, man, you're 22 years old, you're crushing it. Fuck, 30K already in VFE. Fuck, I'd put it all in VFE, man. Just go like all balls in, 100K, get there quick. You don't need dividends right now. You don't need any of that crap. You could even maybe look at the Qs, look at some growth vectors, look, you know, at where you're at already, you could probably take on more risk. You're still pretty young. Maybe look at a couple individual stocks. I'm not recommending Tesla or Meta or anything like that, but, you know, maybe just take a couple Gs, you know, look for something that interests you. It could be something in crypto. You can see, just find something that interests you that you think you have some kind of edge on, and then just maybe throw a couple grand at it, because it's not going to kill you at 22 with 30K already invested. You're making more money. Remember, don't sell it, but go make more money and use that for a little, maybe a few speculations, because you're so young. This is the problem, right? Like the dilemma is people are like, you should just be putting it in the S&P 500 because you have a lot longer to compound it. But to me, I'm like, you're also young and dumb and you have more time to take risk. Like, I mean, when you get into once you get into your 30s, like I can't put 10 or 20% of my portfolio, you know, necessarily in Tesla. I mean, that's risky as F, because like that could implode like the time scale I have to retirement. Whereas in your 20s, I mean, you could blow 10K and it could just dissolve and it could be half your net worth, but you have the next 10 years to catch up. And even if you're overpaying for a company like Tesla or Nvidia or some shit, like that's where valuations don't make sense anymore. Because like if a long-term perspective, Nvidia might look expensive today, which I think it's a bubble. I wouldn't buy it, but I'm just saying like 10 years from now, Nvidia could be worth double what it's worth today. And it could catch up that value over a decade. Like, you have so much time to actualize risk and growth. And it's a beautiful thing to be young at 22 and actually be at the stage you're at. So congrats. You're going to crush it, bro. You're going to be retiring in your 30s, if maybe even before you're 30. Let's be real. If you're already fucking that far ahead, it's crazy. Please never be a Blossom influencer. Why? What do you got against it, baby? Even PPC Ian's a Blossom influencer. I just, like I said, I just don't use, I like the app. I use it. I don't have anything negative to say about it. QQQ beats VO over time. Yeah, but there's a lot of overvaluation. You're taking on risk, right? QQQ might be doing well today, but you know, you got to wait and see what happens. I'm not stating it's a bad thing. I wouldn't just say because QQQ's outperformed that it's going to continue to outperform. Diversity is good. And I think VOO is a really good place for diversity. And then, maybe buy some Qs as well, a little bit of Qs, NASDAQ 100. Blossom pushes dividend investing. That's because they're Canadians. All Canadians push dividend investing. It's all we're really good at. Let's be real. What else are Canadians got lots of time? Yeah, if you got lots of time, there's nothing wrong with the Qs. Yeah, I think that's the problem with Blossom. They're just pushing into the US now. They're just launching in the States. And the problem is Canada is like, oh, we have Royal Bank and we have Fortis and we have, some of these CNR and Alimentation Couche-Tard, and I don't know. Canada is a great place for income. It is not a great place for growth. On that note, I'm going to kick out here, folks. I appreciate y'all stopping in on the first day back. I got a lot I want to talk about, so I'm getting all excited after coming back from vacation. So it should be fun as we're heading into probably continuing to be the most fascinating times in human history. Robotics are coming, baby. AI is taking over, and interest rates may still implode the housing market. Who knows? Time will tell, but we'll be here doing it together. Peace.